A housing affordability crisis lingers in the country, and Zillow thinks they're going to solve this affordability crisis. They're so out of touch with reality now. Zillow is attempting to help first-time home buyers achieve the goal of homeownership by rolling out a 1% down payment mortgage program, thinking, this is going to be able to help people afford to buy a home. Now, this could eventually cause a crash because people are not going to be able to afford the higher payments, because when you have a lower down payment, you're going to have to borrow more money. Diane from the Cardano team, and here today to unpack this program for you today, get you some details of what's going on, and of course I'm going to share with you my opinion, because you know I am not a huge Zillow fan. I just can't hold back on this one. Don't forget to like this video and subscribe for some more juicy videos like this. So let's get started with interest rates. The 30-year fixed rate today is about 7.7% in September 12th. They're getting up there towards 8%. It's not a good scenario being able to afford a home these days. It's becoming next to impossible for a lot of people. So these executives at Zillow think they can solve this problem. They've created a 1% down mortgage payment. And remember, Zillow is a business. And the second quarter of this year, Zillow reported a $35 million net loss. Now, last year, they closed up their iBuyer program, where home sellers were able to submit their photos of their home to Zillow, and they would make you an offer. They'd buy it from you only to turn around and fix that home up and sell it on the open market. Well, yeah, no, that didn't work. So now they're dabbling in the mortgage business with the hopes to connect consumers with a real estate agent to make a referral fee, make some money there. They're only giving realtors this real small commission. Now, they're trying to recoup those losses that they lost from the iBuyer program, and now they're branching out into the mortgage business. So let's look at this 1% down mortgage payment. Is this really a good program for you to take advantage of? And by the way, as always, feel free to comment, and I love reading comments, and I love engaging with you in conversation with you. So here is what the program looks like. It's a down payment assistance program. To the borrower is going to only put down 1%, and Zillow is going to kick in the other 2% from a grant, and that 2% will come at closing. It's not a payment to the borrower. So once they come to closing, Zillow is going to kick in that other 2% to make it a full 3% down on the loan. Now, this is only available right now in Arizona. This is the first state that they're rolling it out on. They do hope to expand to other states. Now, I don't know the timeline for that, but as of right now, this is only available in Arizona. So there are 5 requirements for this program. 1, you have to be a first-time buyer. So if you're a second home buyer, if you're looking to buy a second home, or if you sold a home and now you want to buy another home, you don't qualify for this one. You have to be a first-time buyer, first time ever bought a house. Second, you have to complete a home ownership education course. And 3, you must intend to occupy the property as your primary residence. And 4, you also need to have a minimum FICO score of 620. Lastly, you have to have an income of 80% of the area median income where that property is located that you're going to purchase. Now, Zillow is not the only one offering these low down payment programs. There's other companies like Rocket Mortgage, Guaranteed Rate Mortgage. They're offering 2% down mortgages. Some of the local banks here I know of in Philly area in the burbs, they're also offering these programs. Now, of course, you're going to have to pay an exorbitant amount of private mortgage insurance on top of your regular monthly mortgage payment. So remember, anything under 20% down, you're going to have that PMI, or private mortgage insurance. So what's the goal? The goal is to help people get into a home faster without having to put a lot of money down. Now, buyers have to spend less time saving money to get into the home. So an example, if you buy a $275,000 home in Arizona and you make 80% of the average median income for the area, a buyer can save just 5% of their income a month for the down payment. It's going to take them about 11 months to save that 1% down. Now, in comparison, that same buyer, if they wanted to save a 3% down program and get a payment of 3% down, it's going to take them 31 months to finally save that 3% down payment. So you see the whole logic behind here. If they want you to be able to get into a home faster so you can get that money saved up in 11 months versus 31 months. Now, the question lies, is the buyer going to be able to afford the monthly payment that comes along with it, since if the mortgage payment will be $1,902 per month at 7.7% in this example, compared to $1,569 a month for someone putting 20% down. Now, that's almost a $350 per month difference. Now, you have to make sure you're going to be able to make that monthly payment, plus you're going to want to have money left over at the end of the month to be able to save and do things with your life. And then you have to pay private mortgage insurance, which right now you cannot write off on your taxes. So let's review the pros and cons of this 1% down mortgage payment program. The pros are you're going to be able to purchase a home faster and reducing the amount of time you need to save for that down payment, like I said. 2, you won't have to deplete your savings, so you have some money left over to cover your closing costs or any other expenses. And another pro is if you can buy a home home sooner, you'll be building equity faster because you're not renting anymore and paying your landlord's mortgage. So that's good. Now the cons, and most importantly, you're going to have a larger loan amount, means you're going to have a higher monthly payment, as I talked about. And second, you'll have the risk of negative equity. So if you buy that house and soon after home values drop in that area for whatever reason, you're now going to have to go be like underwater on your loan. You're going to have to end up owing more than what your home is worth. 3, you're going to have to pay more private mortgage insurance, which in this example could add between $200 and $300 more to your payment. And lastly is a real big one. We're still in a seller's market. In the last 3 years, I've listed and sold many homes, and there's been bidding wars for most all of them. Even last weekend, most people were putting down at least 20% down on their offers, and many of the offers were accepted cash. So if you're going to use this 1% down payment and you're competing against these other buyers who are putting down more money, you're going to have a lot of disappointments. And your chances of actually getting a home are like next to nothing. I really don't like saying that, but that's what's happening here. That's the truth what's happening in Philly and the burbs, and also South Jersey. That's where I sell homes. This is what I've experienced. So it's going to be hard. It's going to be hard to compete overall. I don't know if I really like this loan. It's good to be helping make homes be more affordable up front. Now, I would never use Zillow or tell you to use Zillow to get a mortgage. That's for sure. Now, I have a great lender who can help you out with this process. She can tell you exactly what you expect to pay for your private mortgage insurance. Expect to pay that for about 15 years into the loan, unless you double up on your mortgage payment. Then you could probably knock it out a lot sooner. So the question is will these loans be a cause of foreclosures like we had back in the housing crashes in 2008? Now, some experts are fearing that these loans could potentially be a problem and people are going to default on them. However, I don't think so. In the crash of 2008, people were really low credit scores. They're getting approved for a loan. That's not really the case anymore. Right now, we don't really have strict underwriting guidelines. For those 1% down loans, no matter what company you work with, they're going to be requiring a minimum credit score, a FICO score of 620. For an FHA loan right now, you just need 580 credit score. So it's tighter than FHA. And it's not really like 2008 right now. I know some people are still in shock from what happened in 2008. I don't want anybody to be in that position, and I can appreciate that. So just have to watch out for home values dropping in your area where you purchase, and the other risk is when you have a higher monthly payment. There's some economic downturn. There could be job losses, and you could be stuck with this high mortgage payment. So please do not overspend or go beyond your means. Make sure you're able to afford this monthly payment, plus have money at the end of the month in your bank account, because if you're living paycheck to paycheck to pay off this mortgage, it may not be worth it. However, there's so many benefits about owning a home. Homeownership is the American dream. So if you can afford the payment, for example, if you have 2 people on the mortgage with both incomes, you can afford the payment. It's definitely better than renting, and you can still have your pride of home ownership. And my suggestion is to get my copy of my budget worksheet, a link in the comment section below. We can put all the numbers in there, and you can see whether this program is good for you. Feel free to comment below what's happening in your area. If you have any questions about whether or not this is a good program, is good for you, happy to answer them. Thanks for listening, and we'll see you on the next one.